Given today's environment, since February, March, there's been a lot going on, I think, in the world, to say the least. But when it comes to tax planning, certainly that's not hasn't changed, I think, as far as being less important. Perhaps it's even more important right now and presents opportunities, as you've highlighted, for some of these changes. What are just with your clients, speak for a few minutes, what are some of the best just tax planning strategies and opportunities that you're seeing across your clients right now and helping them with, not so much in preparation, but other areas perhaps?
Absolutely. Yeah, now is really the time that any taxpayer should pay attention, should have the radar up as far as tax planning. Um, Before the end of the year, once January 1st rolls around, your ability to manage and minimize your tax exposure is limited. Um, Prior to December 31st, you have a lot of tools, and some of the tried and true tools that really haven't changed much over the years are for cash based businesses, for example, the ability to either accelerate expenses into this current tax year, create another deduction by prepaying some of next year's expenses, and there's rules around that, or deferring revenue that you might normally recognize this year, deferring it into next year. And an example might be a cash based, let's say, law firm. And if a law firm has, let's say, going into December, has a fairly large billing, they could manage that and delay that until the end of December, understanding that they're probably not going to receive the fees on that until next year. So that's a tried and true way to kind of push income into the future. And if a taxpayer is in the same tax bracket, um, the advantage is the time value of money. Basically, it's deferring paying $1 of tax to the government for another year. Um, but managing the tax brackets really becomes very important. Kind of some of the newer strategies that have come about as a result of the 2018 Tax Act are generally related and around the Section 199A deduction, which basically is the 20% deduction that is available to small businesses that are either sole proprietorships, partnerships, or S corporations. And um, some of the some of the sophisticated strategies that we've looked at there are, if a business is considered what's called a specified service trade or business, um, that 20% deduction is limited once their income exceeds a certain level. So there's strategies to be able to reduce their income below that threshold such that they're able to take advantage of that 20% deduction. And some strategies include making a SEPR IRA contribution, for example, um, maybe buying new equipment that might be needed over the near term, maybe 1 or 2 years. And under the new law, you can expense that equipment as bonus depreciation. As an example, Mark, I had a client this past year that was in a unique situation where, um, by making a SEP contribution, a full maximum SEP contribution of $55,000, they were able to save almost the same amount in taxes. Now, what that means is the $55,000 SEP, Simplified Employee Pension Contribution, is not money out the door. It's not money going to somewhere else. It's basically a savings account for them. And then the government is basically providing them a match in terms of tax savings. So those are some of the interesting strategies that we can model out in tax projection. Um, Certainly going back to some of the tried and true strategies, harvesting losses at the end of the year in a portfolio. If a taxpayer has recognized gains either through sales of securities, real estate, or even capital gain distributions in their investment accounts, creating losses by selling loss positions at the end of the year, and then either reinvesting in the same security after 30 days has expired or a similar holding, is a good strategy. It basically locks in that loss that offsets the gains that have been recognized during the year.